Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Energy Transfer stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 47 billion market cap. They're trading at $14 a share, and there are 3.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They're simply a cash cow. They do generate a ton of free cash flow. Look at 2021, over 8 billion. They're not nearly as dependent on oil prices as upstream and downstream companies, but they're still slightly dependent. In the trailing 12 months, they had 6.3 billion of free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. When you see net income so low compared to free cash flow, it probably means lots of write-downs. When I say write-downs, that's usually goodwill impairments or physical asset impairments. After that, they have lots of profit. 7 billion, 6 billion, a little over 5 billion in the trailing 12 months. Revenue is a sales for the company, and they have the most revenue out of any midstream company. Almost 90 billion in 2022, close to 80 billion in the trailing 12 months, which is more than double 2020's number. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 77 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $70 billion. We divide that by 3.4 billion shares. And we get a calculated stock price of $21. They're trading at $14, so they're trading at a 33% discount. It's a pretty strong buy according to the model. I bought a big chunk of this stock a couple of years ago. My cost base is $864. If you factor in the dividends, I'm up close to 100%. So I'm really happy with this investment. There are 48 companies in the same industry as ET, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. In terms of CapEx, they spend a good amount, 3.3 billion. TC spends the most, over 6 billion. Oil and gas midstream companies spend a lot in CapEx because they have to build the pipeline infrastructure, which is really expensive. And some of these companies transfer oil by vessel. That's also a big CapEx spend. Lots of companies have no CapEx spend. Like for instance, if you manage a website, say you sell products through a website, you probably don't spend anything in CapEx, assuming you don't manufacture the products. If you just buy and sell them on your platform, there's really very little CapEx spend. But if you manufacture products, like an auto manufacturer, then you have a lot of CapEx. The factory, the equipment, that gets all put into the balance sheet and depreciated over the useful life. It gets capitalized in the balance sheet. Since these companies spend a lot in CapEx, they don't have that good of a debt to equity ratio. They're about average, they're 1.5. That means for every dollar of equity, they have $1.50 of debt. Cheniere is really leveraged at 6.5. The reason a lot of people like this industry is because most of the companies pay a sweet dividend. Look at ET, 11%. That's a great dividend. The average is close to 7%. But a lot of these companies are MLPs, Master Limited Partnerships. So usually most of the dividends are taxed as ordinary dividends, not qualified dividends. So you get less back. You pay more in taxes. So I'd rather get a 6% yield from a regular company than say a 6.5% or 7% yield from an MLP. But of course, I'd rather get an 11% yield from an MLP than a 6% from a regular company. ET generates a ton of free cash flow. Look at Cheniere, they're number 1, 7.7 billion. ET is ranked 5th in market cap. Enbridge, the Canadian company, is number 1, close to 70 billion. This company has amazing price multiples. They're trading at 9 times earnings, 7.5 times free cash flow. Cheniere looks really attractive. Maybe I should do a video on them. Look at that PE, 3.6. Free cash flow, 5.7. It's like they're giving the company away. Why are their price multiples so good? Let me know in the comments. And ET generates more revenue than any company in this industry. More than twice as much as Enbridge. And they're still growing. Their 5-year annual revenue growth rate is 9%. Look at Antero, 89%. I wonder if that's from an acquisition. Sometimes the growth rate looks really attractive, but it's due to acquisitions. Cheniere's looking really good, 27%. Sharif Suki got ousted from Cheniere. Now he runs a different company. Sharif started Tellurian. I did some videos on Tellurian. Maybe I should do another video on them. Let's dig into their 10Q. This is their third quarter 2023 10Q as of 9/30/2023. We always start with the income statement. This is the third quarter of 2023, third quarter of 2022, the first 3 quarters of 2023, and the first 3 quarters of 2022. So revenue is down. It was almost 23 billion. Now it's almost 21 billion. That could be due to oil prices. They give a nice breakdown of their revenue. Refined product sales, it went from 6.6 billion to 6.4 billion. Because when oil is pulled from the ground, it can't be used for anything. It's really useless. It has to be refined. You take the raw oil and refine it to something useful, like jet fuel, gasoline for your car, and many, many other things. Crude sales is up a lot, 5.8 billion to 6.6 billion. So they sell the crude product and somebody else refines it. NGL, natural gas liquids, that's down 4.8 billion to 3.8 billion. It can be a really profitable venture to extract the liquids from the natural gas. After they're extracted, they're later separated into different components. Natural gas liquids are hydrocarbons. A hydrocarbon is a molecule composed exclusively of hydrogen and carbon. NGLs could be used in a lot of things. Cooking, plastics, fuel, gathering, transportation, and other fees. That's pretty much flat from last year, 2.8 billion. That's when they transfer the product through their pipelines from one party to another. And natural gas sales, that's down a lot, 2.6 billion to 900 million. Most natural gas is delivered via pipeline. And natural gas is mainly composed of methane, while gasoline is composed of carbon compounds. Since natural gas is composed of hydrogen, it produces fewer harmful emissions, such as carbon monoxide and carbon dioxide. Let's search their revenue numbers, see if they give different breakdowns. Here's a different breakdown of their revenue. Of the 20.7 billion, 6.3 billion is from their Sunoco gas stations. They own every Sunoco gas station in the US. And you could buy the Sunoco stock. That also trades. Sunoco ticker is SUN. Their market cap is 4.5 billion. They're currently trading at $54 a share. They also own USAC, USA Compression Partners. Revenue from that is only 217 million. That company's market cap is 2.3 billion. They're trading around $23 a share. I'm not sure what percentage ET owns of these companies, but it's definitely over 50%. Because if it was under 50%, we wouldn't see these companies within their revenue. They'd be in a different part of their income statement. Their cost of revenue is 16 billion because they have to buy some of the oil, also the various expenses to run their pipelines. Operating expenses 1.1 billion, lots of depreciation 1.1 billion, SG&A 230 million. So total expenses 18.5 billion, down from 21 billion. They have a lot of debt, so they spent 632 million of interest on their debt. Their net income is over 1 billion. Last year it was 1.3 billion. So their EPS is 15 cents. Half of last year, 29 cents. Let's take a look at their balance sheet. This is as of 9/30/2023 and 12/31/2022. Current assets 13.4 billion. Current liabilities 12.8 billion, so their current ratio is above 1. Let's look at their current assets, 500 million of cash. And if you go to their statement of cash flows, and at the very bottom, you'll see this 514 million. That's the cash and cash equivalents at the end of the period. And the way you calculate the 514 million, they had a cash inflow of 257 million on their statement of cash flows. And to get that 257 million, you take their operating cash flow, 8.3 billion. Their investing cash flow, negative 3.4 billion, and their financing cash flow, negative 4.6 billion. So they had a cash inflow of 257 million for the first 9 months of 2023. And it's just coincidence, but their beginning cash on their balance sheet was 257 million. So I think if you look at their balance sheet on 9/30/2022, their cash should be 257 million. They have lots of accounts receivables, so when they sell on credit, that means the customer buys their service, but they don't pay. They'll pay in the future. So their customers owe them 9.6 billion. They have 2.6 billion of inventory. Let's search that number so we can see what it is. It's 1.95 billion of natural gas liquids and refined products, 169 million of crude oil, and then spare parts, 470 million. If you want to understand a little more about how their inventory works, they use LIFO, last in, first out. A bulk of their balance sheet are their fixed assets, their PP&E. The original value is 109 billion. They depreciated 28 billion. Their current book value is 81 billion. Most of this is the cost of their pipeline infrastructure. They have many, many miles of pipeline that they own. Their total assets, 108 billion, up a little from last year. Sometimes they buy on credit, so they owe their vendors $8 billion. They have a lot of debt, 47 billion. They give a nice breakdown of their debt. 37 billion is notes and debentures. Debentures are unsecured debt backed by the credit issuer. So this is debt they issued, and it's not backed by anything. It's only backed by the full faith that ET will pay on the debt. For instance, if you have a mortgage on your home, that's secured debt. It's secured by your home. So if you don't pay the debt, the bank takes your home. Your credit card is unsecured debt. It's not backed by anything. If you don't pay the debt, you just ruin your credit score. But the credit card company has no recourse. They can't take anything from you. So interest rates are higher on unsecured debt, like debentures. And interest rates are lower on secured debt, like a home loan. And if we dig a little deeper, we could find the interest rates on the debt. They have a 5-year credit facility of 2.8 billion. They also report the debt of their subsidiaries. Sunoco has 3.2 billion of debt. USAC, 1.5 billion. The Bakken project, 1.85 billion. Let's search Bakken so we can learn a little more about it. The balance sheet includes 1 billion of senior secured notes issued by the Bakken pipeline entities, which mature in April 2024. ET's ownership in the Bakken pipeline is 36%. The Bakken pipelines are in the Dakotas, North Dakota, South Dakota. And I think it also extends to Iowa. Let's go back to the balance sheet. Deferred income taxes of 3.9 billion. These are taxes the company will eventually pay but aren't due yet. Since they're an MLP, the unit holders own the company, not the stockholders. 6.1 billion for preferred unit holders and 27 billion for common unit holders. I'm a common unit holder. Let's look at their statement of cash flows. This is for the first 9 months of 2023, first 9 months of 2022. And the first section is operating cash flow. We start with your net income, 3.7 billion. Then you add back the non-cash items on the income statement. We add back 3.2 billion of depreciation and amortization. We also have to adjust for changes in working capital. That's an inflow of 1.2 billion. So they generated 8.3 billion of cash flow in the first 9 months of the year, higher than last year of 7.7 billion. They invested 2.4 billion in CapEx, same as last year. They added 23 billion of debt, that's a cash inflow. They paid down 23 billion of debt, that's a cash outflow. They paid dividends to their partners because I'm a partner, I'm not a stockholder. They also have non-controlling interests. They paid them 1.3 billion of dividends. Their non-controlling interests are in Sunoco and USAC. They show us a breakdown of Sunoco's cash distributions. So they get a dividend just like I get a dividend. They received 84 cents a share. USAC received 52.5 cents. Let's take a look at the company on Simply Wall Street. Its last price, $13.89, 44 billion market cap, up 1% in the past week, up 11% in the past year. Let's learn a little more about the company. ET provides energy-related services. They own and operate 11,600 miles of natural gas transportation pipeline and 3 natural gas storage facilities in Texas and 2 natural gas storage facilities located in Texas and Oklahoma. 20,000 miles of interstate natural gas pipeline. It also sells natural gas to electric utilities, independent power plants, local distribution, and other marketing companies and industrial end users. The company owns and operates natural gas gathering and natural gas liquid pipeline, processing plant, and treating and conditioning facilities in Texas, New Mexico, West Virginia, Pennsylvania, Ohio, Oklahoma, Arkansas, Kansas, and Louisiana. natural gas gathering, oil pipeline, and oil stabilization facilities in South Texas. Also, a natural gas gathering system in Ohio, as well as transport and supplies water to natural gas producer in Pennsylvania. It owns 5,650 miles of natural gas liquid pipeline, NGL fractionation facilities, NGL storage facilities with working storage capacity of approximately 58 million barrels, and other NGL storage assets and terminal with an aggregate storage capacity of approximately 25 million barrels. They provide crude oil transportation, terminaling, acquisition, and marketing activities, and sell and distribute gasoline, middle distillate, and motor fuels and other petroleum products. It offers natural gas compression service, carbon dioxide, and hydrogen sulfide removal service. They also manage coal and natural resources properties. Also, they sell standing timber, lease coal-related infrastructure facilities, collect oil and gas royalties, and generate electric power. They used to be known as Energy Transfer Equity LP, changed their name to Energy Transfer LP in October 2018. They were founded in 1996, headquartered in Dallas, Texas. It looks like they started trading in 2006. Their lowest point ever was during the Great Recession. December 2008, they were $3.84. The highest point ever, $35 in 2015. Oil prices plunged in 2016, so did their stock price, back down to $4. It took another year to hit 20, so it ran up fairly quickly. They fell below $5 during COVID in March 2020, but it's pretty much uphill since then. And you always get that solid, consistent dividend. Simply Wall Street's valuation is 24. They say the stock is 43% undervalued. 18 analysts priced this stock at $18. They also say the stock is undervalued. Here's their trailing 12-month revenue since 2012. It was $17 billion. Then it ran up to $56 billion in 2014. Oil prices came down and it fell to $31 billion in 2016. Came up again to $55 billion in 2019, and as we know, oil prices are very volatile, so it came down to $39 billion. Its peak was $90 billion last year, and it's still pretty strong at $79 billion. And the forecast for 2025 is $84 billion. This purple line is their dividend payment. In 2014, it was 71 cents. That's for the entire year. It came up to $1.22 in 2020. They did cut their dividend to be more in line with the stock price. They cut it to 61 cents, but they brought it back. It's creeping back up to above $1. And the forecast is for the dividend payment to be $1.35 by 2025. If you just look at the blue line, the yield, it was 20% in 2020. Because as the stock price goes down, the yield goes up. But they cut their dividend because it was too high of a yield. So they brought their yield down to 6%. But now it's coming back, the yield. It's about 10% currently, and the forecast is for the yield to be 9.7% by 2025. Mackie McCree is a CEO for 3 years right now. His regular salary is $1.4 million, $20 million total compensation. He's been with the company for about 20 years and other positions before CEO. This is what you like to see, lots of insider buying. Kelsey Warren is their biggest bull. He's the chairman. 1 million shares, 1 million shares, 3 million shares. Look at all these Kelsey Warren buys. He's really gobbling up the stock. And there's only buys, no sells. I got ET in the single digits, but even now it's a great deal. So you can see in the past year, about 11 million shares were purchased by insiders in the past year. Half the company's owned by the general public, 1/3 by institutions, and 11% by insiders. Kelsey Warren is the biggest shareholder at 9.5%. He owned $4.1 billion of the company. Next is Blackstone. Last week, Blackstone acquired Rover. I'm trying to identify companies as acquisition targets because when a company gets acquired, their stock goes up 50% right away. It's not always 50%. Sometimes it's 30%, 40%, 60%, but on average, it seems about 50%. Because Blackstone has to pay a premium to Rover shareholders. Because why would Rover shareholders sell for less than the price? It has to be more. Goldman owns 1% of the company. Another arm of Goldman, 1%. The large French investment bank Natixis owns 0.9%. Fidelity, 0.8%. Lots of big names here. B of A, Brookfield. It looks like their employee count peaked in 2016 at 31,000. It has come down, It's down to $12,600. They must have sold part of their business, which is why their employee count went down so much. The stock trades in only two places, the New York Stock Exchange and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.